Hello friends, today we are going to discuss about the next part of introductory of partnership accounting. The first part link is shared in the description. You can refer that for further reference. In this session we are going to discuss about types of capitals, that is fluctuating capital method and fixed capital method. We'll have two illustrations so as to understand how actually the figures are recorded. As you know, fluctuating capital method is a method where capital figures keeps on changing. Why does it changes? It changes because of the adjustments. Adjustments such as salary, commission to the partners, interest on capital, interest on drawings, etc. So, once we prepare a capital account, the opening figure will keep on fluctuating and you'll get some other figure at the end. Second method is fixed capital method. As the name suggests, the capital should remain fixed. If the capital has to remain fixed, the adjustments as mentioned earlier regarding interest, drawings, etc. are to be shown on a separate account called as current account. So in case of fixed capital method, we have to prepare a capital account and current account. The point to be remembered here is, when you prepare a capital account, you will show maximum 4 items. One is the opening capital figure, second is the additional capital introduced, third is the capital withdrawn, and fourth is the closing calculated balancing figure. Let's move towards the illustration. In this illustration, A and B are the partners sharing profits and losses in the ratio 2:3. So whatever the profit, here it is mentioned 60,000 rupees, will be distributed to the partners in the ratio 2:3. Additional information is available: capital on 1st April, that is opening capital, drawings during the year, interest on capital, interest on drawings, interest on capital is 10%, drawings is 12%, salary to Mr. A 2,500 per month, monthly salary is to be converted into annual while recording, commission is given 15,000 rupees. Let's do the working note. Profit 60,000 rupees, as it is discussed, it is to be distributed in the ratio 2:3. 60,000 multiplied by 2 upon 5 and 60,000 multiplied by 3 upon 5 will distribute it in the ratio 2:3. Amount comes 24,000 and 36,000. Interest on capital 10%. The capital amounts are 60,000, 30,000. 10% comes 6,000 and 3,000. Interest on drawings 12%. Remember, in the question there is nothing mentioned about when the drawings are made. So period of drawings is not known. As per the rules, if the period is not known, interest on drawings is calculated for 6 months. Here it is 12,000, 12%, 6 months, 720 rupees. 10,000, 12%, 6 months, it comes 600 rupees. Salary to A, 2,500 per month, multiplied by 12, get it converted into annual amount, rupees 30,000. Let's see how does it look like in capital account. When you are preparing it in a fluctuating capital method, you have to prepare only one single account, that is capital account. Concept on the credit side, the first item is balance brought down, that is the opening capital figure. As you know, capital always shows credit balance. Interest on capital, salary, commission, and last one is P&L. P&L is nothing but the share of profits. By all these things, capital figure increases. In 11th standard, you might have studied and recorded it in the capital, added it in the capital. Here also, when you record it on the credit side, it automatically get added in the capital. Constant on the debit side, drawings and interest on drawings. Because of this, capital gets reduced, hence it is recorded on the debit side. What is the last thing on the debit side? That is balance carried down. This is the balancing figure of your capital account. So capital account in fluctuating capital method includes all the items. Let's see with the second method, that is fixed capital method. As we have discussed, we have to prepare two accounts, capital account and current account. This is capital account, current account is on the next slide. Capital account, credit side, by balance brought down, that is the opening figure. There is no additional capital, no capital withdrawn, so directly the closing figure comes. Let's see how the current account look like. The all remaining items, that is interest on capital, salary, commission, and share of profit on the credit side. Debit side, two drawings and interest on drawings. In short, in the second method, we are splitting the capital account, which is prepared with fluctuating capital method, into two different accounts. One is a capital account and one is a current account. The balancing figure is mentioned on the debit side. This is the way how we prepare capital account and current account. Let's have one more example. X and Y are the partners. Profit sharing ratio 2:1. The profit for the year is 30,000 rupees. So this 30,000 will get it distributed amongst the partner in the ratio 2:1. Additional information, capital 1/4/2018, that is opening capital. Second item is important, additional capital introduced. We'll discuss about it while posting. Drawings, interest on capital 10%. Interest on drawings, percentage is not mentioned, directly amount is mentioned. So our work is reduced. We need not have to calculate interest on drawings. Salary 2,000 per month, commission 10,000. Let's go for the working note. Profit distribution 30,000 in the ratio 2:1. A will get 20,000 rupees, B will get 10,000 rupees. Interest on capital 10%. Capital figures are 50,000 and 20,000. So interest will be 5,000 and 2,000. Salary 2,000 per month, converted into annual by multiplying it by 12, you get 24,000. Let's go with the first method, that is fluctuating capital method. We have to prepare a capital account. All those adjustments along with the capital figures will come in capital account. Again, constant on the credit side, by balance brought down, that's the opening figure. By cash, this is additional capital introduced. What is the journal entry for additional capital introduced? Is cash account debit to partner's capital. It will go to debit of cash and credit of partner's capital. Next things are same as of illustration number 1. Interest on capital, salary, commission, P&L on the credit side, and on the debit side it is drawings, interest on drawings, and the balancing figure after calculation. Let's see how the fixed capital method will show capital account. As we have discussed, it will have maximum 4 items. See on the credit side, opening figure. Again on the credit side itself, by cash, this is additional capital contributed. There is no capital withdrawn, so the closing figure is calculated. Here we are having by balance brought down and additional capital on the credit side, and on the debit side the balancing figure. With respect to current account, all other things are recorded, that is interest, salary, commission, and share of profit. Debit side, drawings and interest on drawings. I would like to mention one more thing here. Instead of profit, if it is a loss, then instead of credit side by balance P&L, it would have gone to debit side to P&L account. The profits are distributed on the credit side and the losses are distributed on the debit side. This is how we are supposed to prepare the capital account and current account in different cases. To summarize it, in case of fluctuating capital method, we prepare only one capital account with all adjustments, whereas in case of fixed capital method, to make capital fixed, we have to prepare 2 accounts. One is a capital account and second is current account. More importantly, capital account will include opening figure, additional capital introduced, and capital withdrawn. Hence, carried down figure will come. All other adjustments will be shown on current account. That's all for the session. I would like to remind you again that the part 1 link is mentioned in the description. Kindly go through it.